We are back. So what we're saying is, on paper, the Kenyan economy looks perfect. It is the best and ideal investment location, at least in sub-Saharan Africa. However, on the ground, the feeling is very different. Today, we are with Abraham KAMAU, who's the MD, who's the Chief Executive Officer of MIRADI Capital. He's helping us understand these numbers. In the first part of our conversation, Abraham, you just gave us a summary and you said these numbers actually reflect what's happening. But maybe over and above looking at the economic growth numbers year on year, we probably need to factor in the element of economic development to see whether this growth is actually being reflected in other sectors of the economy outside of government spending and driving key pertinent sectors. Now, I want us to get into the sense of different things when you're looking at the government operations.
Yes.
The GDP number is very important.
It is.
Because the majority of the ratios that we are calculating, key in point, debt to GDP ratio, which is at 58%. So the question is it 58%? Is it 40%? Is it 60%? Is it 70%?
Yes.
And that GDP number is very important. But I want us to just change gears before we get into the debt conversation.
Yes.
Looking at the revenue targets that we have been putting for ourselves, the last reported budget, it's very aggressive, very aggressive. And aggressive with regards to expenditure and also aggressive with regards to income. I don't want us to focus on the absolute numbers. I want us to focus on the revenue. How much are we collecting versus what we have actually proposed to collect? And maybe our graphics team can put that up for us. That is graph number 3. So we have graph number 3, and Abraham, in the last quarter, the last numbers that we have, we collected 91% of what we had imagined that we would.
Last year.
That was last year, of what we thought we would have collected. What does this mean for us? Because it certainly has a tie to how much debt we actually need, if nothing else, before we develop the country to actually pay for our expenses every year.
You're very right, because this is about 90. The previous year was about 89%.
Okay.
So in the last budget that was read, we're supposed to raise 2.1. KRA is supposed to raise 2.1 T.
Yes.
Now, if you go by this, if you go by the average of this, the worst they've done is about 90. So if they do 90, that means 10% of that, that's 200 billion.
Already. That's
so we'll be at 1.9.
So we'll be at 1.9.
And the budget is at 3 trillion.
And I think the last amount to collect was about between 1.4 to 1.5 trillion.
Yes.
Okay.
So you see now, we'll have lost another 200 out of collection. So now we'll be at 1.9 collection. And we have a 3T budget. So we're supposed to collect 2.1 and borrow the rest.
Yes.
So now instead of borrowing 900, we
end up borrowing 1.1, slightly more than we actually anticipated.
And as usual, the sort of target is where? Is the local market.
Yes.
Apart from the time when we do Eurobonds. So again, if they do 90%, we will have another deficit by design. Or one extra 200 billion.
So then it's actually something to consider, because we are not necessarily generating sufficient revenue from our tax operations to actually cover our expenditure. And if we look at the nature of our expenditure, Abraham, over the last 5 years, how it has evolved, we didn't have extensive debt maybe 5 years ago. But today, our debt payments, principal and interest, are actually increasing how much expenditure that we need to pay out. I like the element that you've actually brought out with regards to the split between domestic and foreign debt. So the last reported number on debt is about 5.8 trillion shillings.
Yes.
3 trillion of that is external debt. And then 2.7 is internal debt.
Yes.
So you're saying 2.7 trillion could actually grow and actually surpass the foreign debt element?
Yes. You see now, if you have a deficit, you have to borrow.
Yes.
There are no two ways about it. And remember, debt finance alone, out of every 3 shillings we are collecting, 1 shilling.
1 shilling is going.
Debt finance.
Yes.
That's a very big number.
That's about 33%.
Yeah, 33%. So we're almost doing almost a T just to service our debt.
So
now,
wow.
Yes.
So a trillion for servicing debt.
For servicing debt. So now,
and then a trillion is for the wage bill.
Just to run government.
Okay.
Actually more. And you've not even factored what goes to the counties.
Actually, I was going to say a trillion actually pays the national government staff. Then by law, about 360 billion needs to go to the counties.
And most of it again is not developmental.
And okay.
So you're probably left with half a trillion for development.
But Abraham,
yes.
If you're saying almost a trillion is going into debt, and then another trillion is going into national government, and on the flip side, you have said that maybe we could collect between 1.5 to about 1.9 trillion if we're lucky. If we collect 1.5, a similar amount close to last year, we can't even meet paying, we can't pay staff and we can't pay debt.
You see, and you know we've discussed it here. our debt levels, we've reached a point where we have to sit and accept that it's not sustainable. No, not the debt per se, but the structure of it. We have to sit and restructure in a way that it can be done over a longer period of time and with better terms, because one T will not do. Secondly, as you're rightly saying, if we only collect 1.9 or towards 1.5, that means most of what we'll be collecting will just be paid to pay debts. And then whatever is left is to pay salaries. So it means what will be sacrificed? Developmental expenditure. That's what will be sacrificed, because if you can't meet, because people have to be paid, your debt has to be paid.
Yes.
So again, you only save, you only invest what is in excess of consumption and debt service.
Okay.
Yes.
I don't know whether to be worried or to be happy,
No,
because
no.
we keep saying, on paper we look good, but then when you actually begin to dissect
Yes.
these numbers, there's maybe a possible problem somewhere.
Because you see those are the limitations of ratios.
All right.
You see, we seek comfort that we are at 58% and Japan is at 200 or something.
Okay.
Those are the kind of comforts we seek. But those are ratios if we're a company those are balance sheet ratios.
Yes.
But when you go to the cash, we are not doing well because we are not generating enough cash. Remember, this tax comes from businesses.
Yes, it does.
And this economy is not growing the way it should. So you are taxing a diminishing asset.
Okay.
So
Wow.
you see, so what does that mean? So and we've said again here that you cannot shrink yourself to greatness.
Interesting. We'll
Yes.
just put up the final chart with regards to the split between foreign and domestic debt. Abraham, I'm puzzled now.
Yes.
I'm puzzled now because when we're looking at the debt to GDP ratio at 58%, the consensus is, okay, just let it not get beyond this. And then on one end, we're saying, okay, fine, is this GDP number, does it give us assurance? To a larger extent, it gives us assurance. But then on this other side, you're saying our revenues are not sufficient to pay for our existing debt and to pay for our national government expenses, even before we go and start distributing to counties
And
as well as to
the
development.
yes.
So then really what this means is debt either has to increase or taxes have to increase.
You see, the way they dilute this ratio, of course, is the best way is to grow our economy.
Yes.
Because if you grow the numerator, the ratio starts coming down. And when you grow the numerator, it means you generate cash into the economy. But now, when you look at, like for example, our remittances from abroad,
Okay.
our biggest earner, if that trend continues, then even now you start putting pressure on the shilling
Okay.
versus the dollar.
All right.
You see, so
it has an overall-
yeah, everything seems to be coming home.
Okay.
And I think it's high time we sit and see what is the cause of all this. Initially, debt is one of them.
So debt is one of
and
them.
number two, the high wage bill.
And the high wage bill.
Yeah.
Okay, fair enough. So as we end this show, because you're an economist, you look at the numbers, this conversation that we've had.
Yes.
Can someone make money in Kenya today investing in equities?
Yes, you can, and this is the reason. A lot of equities right now are on the downside, but this economy has proven over time, if you look at historical data, to be a very resilient economy.
Okay.
In fact, it is when it is weakest is when it's strongest.
Yes.
So I believe that if someone was coming in, they should, and that's why you see, look at the Safaricom counter. The investors are still coming back. They're gone.
But it's only Safaricom,
It's Safaricom.
Abraham.
But Safaricom always leads.
Yes.
They'll first go to Safaricom. It's
then-
normally like the test, and then everything else follows.
Fantastic.
Yes.
Then our very, very final question. Today we're trying to answer, do these numbers that come out of our data of the National Bureau of Statistics as well as the Central Bank of Kenya, do you give them full comfort with regards to using them as a basis for evaluating the economy of Kenya?
Personally, I would qualify them.
You would qualify them.
And only to this extent. To the extent that the public is not given, whenever you have data, you have to first give it the source. The source is there.
Yes.
But methodology.
Methodology.
And if somebody wants to interrogate them completely,
Okay.
they should have the benefit of the primary data.
The primary data,
Yes.
which is what we need.
Yes.
Thank you so much, Abraham, for your time. So there you have it, ladies and gentlemen. The numbers are good, but probably there is an opportunity to be able to understand the methodology and also get access to the primary data so that we can be able to reconcile. Kenya does look good on paper. It doesn't look as good when you go to the ground. For this gap to actually be met, we need a bit more information and insights to validate this data that we are actually getting. But on the flip side, I think think the equities actually still continue to offer a good opportunity. They are trading at a 10-year low with regards to the NSE 20. We continue to see buying interest in Safaricom, showing us that there's actually slightly more confidence in the market when the foreigners are coming into this market. Thank you for joining us. We will see you again tomorrow at the same time. That is 2:30 on Metropole TV. We are streaming live on Facebook and on our YouTube page. Good afternoon.